There's going to be a ton of companies reporting earnings between February 23rd and February 27th. We've picked out 7 that we're going to keep our eyes on. Now we have on Tuesday, Home Depot, Mercado Libre, and First Solar are reporting their earnings. Wednesday is NVIDIA and CRM, which is Salesforce. And Thursday is Intuit and Monster Energy Drinks. Now, some of these companies we hold in the Interflame Finance portfolio, some we don't. Some we're just taking a look at today to see what might be in store for the economy in the near future. Now, what we're going to do with these companies is we're going to look at their past performance and we're going to rate and score them with the Interflame Finance methodology and scoring system. Then we're going to take a look at their intrinsic values to make sure that if we were to buy these companies that we're getting them at a good price. We're going to compare those intrinsic values with analyst expectations. And finally, we're going to look at how to maybe hypothetically invest $1,000 into these 7 companies. Now, first up is Salesforce, CRM. Salesforce has been beaten down. If we look at the past month of Salesforce, we see that they're down about 18.47%. The past 3 months, down about the same, 18.75%. The past year, you would have lost 43% of your investment on Salesforce. However, the past 5 years, we're still down about 25% over the past 5 years. Think of all the gains in the S&P 500. Think of all the gains in the NASDAQ in the past 5 years, and then think about losing 25% of your money into Salesforce. We do, however, see a 4,800% gain in Salesforce since about 2024. So it is a strong company. It is a strong stock. These have been beaten down with AI fears, and we're going to take a look right now. Now, what we like to see about Salesforce is they have very low debt to equity at 0.2%. They have a PEG ratio under 1. We like to see that a lot for growth companies. They have a forward PE at an astonishing 14.4 and free cash flow yield at 7.4%. Now, next up is First Solar. First Solar is a company that we've held in the Interflame Finance portfolios for over a year now. First Solar has been very good to us. A PEG ratio at a fantastic 0.3 still after all this growth. Forward PE coming in at 11. Profit margins very healthy, 27.7%. And a 5-year forward PE for First Solar coming in at 6.0, which means if you buy First Solar today, based on their anticipated growth, you're getting it for a PE ratio of 6 in the next 5 years. Now, First Solar is basically flat over the past month. If we look at the past 3 months, we're actually down 4%. Over the past year, a fantastic 49% gain. We bought heavily in about between March and May of 2025. The past 5 years, we are up 166%. And overall, First Solar, the largest solar panel producing company in America, is up about 890%. Now, Home Depot is a company that we do not hold in the Interflame Finance portfolios. However, it might give us a look into the state of the housing market and what people might be expecting. So we're going to look very carefully at Home Depot's earnings when they announce them on Tuesday to see, are people maybe renovating their houses? Are they getting ready to sell? Are they anticipating maybe drops in interest rates? We will see. But the PEG ratio coming at 9.5, not good at all. The only thing that really stands out is their return on equity, about 163%. They have very high debt to equity. So this is something that we're looking at as a growth company, not very good growth company, and just not very good numbers overall. Home Depot basically flat in the past month. Over the past 3 months, they've actually had a fantastic 14% growth. Over the past year, they're a little bit worse than flat, down about 3.3%. And actually underperforming the market over the past 5 years, just 30% growth in the stock price for Home Depot. Intuit is another software company that's just been beaten down in recent months. PEG ratio, a respectable 1.1. Debt to equity, very low at 0.4. We like to see that. 5-year forward PE at about 11. Free cash flow yield, almost at that 7% mark that we like to see, but 6% is pretty good in and of itself. Now, Intuit stock has had just an absolutely terrible month, down 30% in that time. In the past 6 months, we see pretty steady, and then all of a sudden, in the early part of January, we see that the software companies as a whole, especially Intuit, crash. You would be down 46%. In the past year, you would be down about 35%. And even in the past 5 years, you would still be down about 7.5% for Intuit stock. However, we look at Intuit since the early to mid 90s, and we see that if you had held this company at that time, you'd be up about 16,000%. Now, what's important to note is that these prices are at late 2022, early 2023 prices. This is when the stock market as a whole had been battered for a whole year. 2022 was an absolutely terrible, devastating year in the market, and you're basically getting these companies at 3-year lows. Now, Mercado Libre has pretty good scores across the board. We see 21.5% revenue growth, about 30% EPS growth, free cash flow yield coming in as the best of all these 7 companies at 7.5%. PEG ratio, not too terrible at 1.2. However, debt to equity, a little bit high at 1.8. We'd like to see that come down. Forward PE, some of the highest of these companies that we'll see. And their 5-year forward PE actually in the low to mid-teens at 13.0, given that very strong expected EPS growth. Now, Mercado Libre has not had the best month, down about 3.5% in that time. Over the past 3 months, basically the same, down 3.87%. Over the past 6 months, we see that they are down about 14.5%. Over the past year, again, the stock market's had a fantastic year, but in Mercado Libre, we'd be down 3.8%. And in the past 5 years, Mercado Libre is only up 4.5%. All the gains you would have missed out on in the market, in the Mag 7 type companies, in the NASDAQ, completely out of reach had you invested in Mercado Libre in the past 5 years. However, if you look at this company since about mid to late 2007, you would be up 9,000% on your position. Now, a fun fact about Monster Energy, this is the best performing stock in the past 25 years. Monster Energy, had you invested just a moderate amount of money, you would be a multi-millionaire in this company. Debt to equity ratio, basically zero. Return on invested capital, 28.4%. Other metrics across the board not looking too fantastic. PEG ratio at a 2.5. That's a little north of what we'd like to see. Now, the past month, they've had a fantastic 30 days, up over 7%. Past 3 months, even better, up about 15.85%. Over the past 6 months, even better, up about 31% in the past 6 months for Monster Energy. Past year, even better, way outperforming the market, 62% in Monster Energy over the past year. Over the past 5 years, outperforming the market at about 87% growth. And here is that just amazing growth for Monster Energy. If you go all the way back to mid 1992, had you been a shareholder with even just a moderate amount of money into Monster Energy, you would be up 403,000%. That is just insane growth for the stock price of a company. And again, the best performing company, the best performing stock price in the past 25 years, they're beating out NVIDIA, they're beating out Tesla, they're beating out Google, they're beating out Amazon. Monster Energy has been the place to invest in the past 25 years. Now, of course, that does not mean that they will be the best place to invest in the future. We will take a look at those numbers in a bit. And finally, the most anticipated stock in this earnings season is NVIDIA. They have amazing return on equity of 107%, amazing return on invested capital of 115%, profit margins at a ridiculous 53%, revenue growth expected to be 28% every year for the next 5 years, EPS growth coming in at 39% every year for the next 5 years. We see debt to equity extremely low at 0.1, PEG ratio at 0.6, it's under 1, we like to see that, and a 5-year forward PE for NVIDIA at a 9.0. That is just great, great, great valuation metrics for this company. And you know all about this company. It's NVIDIA. Past month up about 1.9%. Past 3 months up 1.77%. Past 6 months up 8%. Over the past year, beating the market up 36.34%. And now we're starting to get into those big numbers. The past 5 years, had you invested into NVIDIA and held, you would be up over 1,100%. And indeed, over the past quarter century, you would be up 433,000% in NVIDIA. Now, how are these scores coming in for these companies? If you're new to this channel, what we do is we score companies between -10 and +10. -10 is garbage, +10 is perfect, 0 is neutral. We like to pick companies that have scores of 5 or higher. We want to make sure that we're picking quality companies above neutral. So the first one is Home Depot. They're actually neutral at 0. Not too great numbers across the board. It's that high forward PE, it's that high debt to equity, it's that high PEG ratio. As far as a growth company, Home Depot, we're not interested in. Monster Energy, right off the bat, coming in at a 5. Again, we see that they have very low debt and great return on invested capital. Mercado Libre, tying Monster at a 5. And again, Mercado Libre, great numbers, high revenue growth and high EPS growth expected. And we see that 7.5 free cash flow yield, the best of all of these 7 companies. Salesforce coming in at a 6. Salesforce is a solid company. They have great forward PE and they have great free cash flow yield. Intuit coming in at a very strong 8. NVIDIA coming in also at a very strong 8. And First Solar also coming in at an 8. So there's a 3-way tie for first place. First Solar, NVIDIA, and Intuit for the growth scores. Before we get into safety scores, if you're getting anything out of this video, please consider liking. That would really help the channel. And please consider subscribing to this channel so you can come back for more scores and stock analysis for companies. So what about safety metrics? Salesforce comes in, dividend yield 0.7%, so this is not a strong dividend paying company. They have grown their dividends a very, very moderate 4%. That's basically just a little bit more than inflation. However, their payout ratio is 24%, so we have faith that they can continue and maintain their dividends, maybe even increase over the years. They have grown their dividends for 2 consecutive years. First Solar has the best PE ratio of all 7 of these companies, coming in just under 19. They have one of the best 5-year forward PE is coming in at a 6.0. However, they do not pay a dividend, so that's likely going to hurt their safety scores. Home Depot does pay a dividend. They have a dividend at about 2.4% dividend yield. They have grown their dividends for 16 consecutive years, almost a dividend aristocrat. And they have grown in recent years about 2.2%, just a tick under inflation. Intuit is also a dividend payer, second place for dividend yield coming in at 1.2%, dividend growth an astonishing 15.5%, and they have grown their dividends for 15 consecutive years. Mercado Libre is also a company that does not pay a dividend. However, they have the best free cash flow yield of all these companies. They have debt to equity coming in above 1. We don't like to see that, so that's probably going to hurt their safety scores. And we also see that they have a very high valuation coming in at about 49. Monster Energy, no dividend yield, probably going to hurt their safety score, but their return on asset, some of the best of these 7 companies, coming in at 18.2%. And finally, NVIDIA. I mean, they do pay a dividend. You can't even see it because I believe it's about a 0.02% dividend yield. Dividend growth, 17.7% in the past few years. They have grown their dividends 2 consecutive years. Their payout ratio, basically nothing, 1.1%. I mean, their dividend is a joke. It's there, but it's basically non-existent. Debt to equity, that's going to help their safety scores coming in at 0.1. Their return on invested capital, their return on assets, phenomenal. Those are going to help their safety scores. And 5-year forward PE, the second best of all these companies, coming in at a 9. So Mercado Libre is the least safe company, coming in at a 1.4, also on that -10 to +10 scale that we were talking about for growth. Monster Energy, also, since it does not pay a dividend, also not too terribly great as far as a safety company goes. NVIDIA, they have a very low dividend yield, basically non-existent. They have solid numbers across the board in all other regards, but we do like that safety and dividends, so that is what's hurting its score right now. Home Depot, they do pay a pretty hefty dividend at 2.4%, and they have grown their dividends. Their payout ratio, about 62%, that's getting up there, but they probably don't want to lose any potential dividend aristocrat status, and so they'll probably maintain those dividends. Salesforce coming in at a 5.7, due in large part to their fantastic free cash flow yield at 7.4% and their great PE ratio, currently 25. First Solar is actually tied with Salesforce, also at a 5.7. And finally, Intuit coming in, safety of 7.9, due in part to their decent dividend at 1.2% yield, dividend growth at 15.5%, and 15 consecutive years of dividend growth. So we know which companies are good growth companies, we know which companies are good safety companies, so therefore we can figure out which companies are the strongest of these 7. But we don't want to know just what these companies are in terms of their score. Are they good or bad companies? We want to make sure that we're buying them at good prices. And so what we are going to do now is run what's called the intrinsic value of these companies. The intrinsic value is a way of estimating not what the price is, but what the value of this company is. And so you can see I have Home Depot's pulled up right here. And what I've done for Home Depot is I have done a PE ratios model, I have done a dividend discount model, and I've done a discounted cash flow model for Home Depot. And what I have done is I have averaged these 3 scores, and I've gotten the intrinsic value for Home Depot at $277 per share. Now, if you want to see how to build out these spreadsheets in Google Sheets, I have links in the description below that you can build out your own models to run it for Home Depot. You can use your own numbers for Depot, or you could even do it for any other ticker, any other company. I'll show you how to do it in the links in the description below. Check them out. It is an absolutely essential tool for any investor in their investing toolbox. So for these companies, what I'm going to do is I'm going to weight the growth and the safety scores equally. They're both going to have a weight of 5, so growth and safety will become equally important in their average score. So first up, Home Depot, a growth score of 0, safety score of 5. That means that their average score is 2.5. Again, we like to see that number coming in at 5 or higher. Intrinsic value for Home Depot, 277. Their current stock price is 382. That means that there's a 38% premium on the stock price of Home Depot, something that we are not interested in right now. So we think Home Depot is going to come in at about $277 per share. That's their intrinsic value. And that is more bearish than even the most bearish analyst who says that Home Depot is going to go down to $350 per share. That would be about a 8.5% decrease in Home Depot stock over the next year. On average, analysts see between a 10 and 11% increase in the stock price. That's basically in line with what you would expect from the market as a whole. The highest analysts coming in at 30% at $497 per share. So when it comes to Home Depot, we have 9 strong buys among analysts. We have 10 buys. There are 4 analysts that say hold and 0 that say sell or strong sell. So we diverge from the analysts quite a bit. We say $277 per share. We are not interested in Home Depot. However, analysts think on average Home Depot is going to go up about 10 to 11%. Let us know in the comments what you think about Home Depot stock. Now, next up is Mercado Libre, completely different story. They had growth at 5, they had safety at 1.4. That gives them an average inner flame finance score at 3.2. Current stock price is just a tish under 2,000. However, we think that Mercado Libre is actually worth $3,800 per share based on our growth and valuation metrics. That means that Mercado Libre currently has a 47% margin of safety for its stock price. Now we say 3,800 at Interflame Finance, and the most bullish analyst says 3,500. So we are pretty much in line, a little bit higher than the most bullish analysts on Wall Street. On average, however, analysts are saying that there's between a 44 and 45% increase in the stock price for Mercado Libre over the next year. Even the most bearish analyst says that Mercado Libre is still going to go up about 30%. Mercado Libre has 9 strong buys among analysts, 7 buys, 1 hold. Nobody says sell or strong sell for Mercado Libre. So it seems whether you believe the analysts or whether you believe Interflame Finance, there's definitely room for growth in Mercado Libre stock over the next year. Monster Energy, an average Interflame Finance score just under 4. The current stock price is $84 per share. We think intrinsically really worth $48 per share based on our estimates. That means that there's a 75% premium on Monster Energy. Now, our estimate of $48 per share is basically on par with the lowest analyst expectation at $50 per share. That would imply a 40% drop in the stock price. But even the average analyst thinks that Monster Energy has some room to go down in the next year, coming in between $76 and $80 per share. That would imply between a 5 to 10% drop in the stock price in the next year. So analysts aren't too particularly enthusiastic about Monster over the next year. 4 are saying strong buy, 5 are saying buy, 7 say hold. Nobody says sell, but there's actually one analyst coming in for a strong sell, and that's probably the person saying $50 per share. Now, NVIDIA is the first company that we are seeing with an average score above 5.8. They have growth at 8, they have safety at 3.6, so that averages out to 5.8. Current stock price is $190 per share. Interflame Finance predicts that that is a $216 intrinsic value for this company. Now that gives us a 12% margin of safety at $216 per share. Now we are on the lower end of the average among analysts. Analysts think that NVIDIA is going to be between $250 and $255 per share. That would be between a 30 and 35% increase in the stock price over the next year. The highest analyst coming in saying $352 per share. That would be over an 85% increase in NVIDIA. However, there are analysts that think that there's some room for NVIDIA stock price to go down, coming in at $100 per share. That would be about a 47% drop in the stock price. There are 21 analysts that say that NVIDIA is a strong buy. 16 are saying buy. Only 1 is saying hold. Nobody's saying sell, but there is that one strong sell from that one analyst saying $100 per share. So let us know in the comments what you think. It seems like all signs point to NVIDIA having strong earnings and possibly an increase in the stock price. They're going to continue to run, but there are some more bearish sentiment on Wall Street. Let us know what you think in the comments below. Salesforce coming in strong with a score of 5.85. They are currently trading for $185. We think that that's actually $100 undervalued, that they should be trading for $285. That would imply a 35% margin of safety in their stock price. Now, $285 per share is basically in line with Wall Street's expectations at about $311 per share. So analysts think that Salesforce is going to go up between 65 and 70% in the next year. The high analyst coming in at $405 per share at a 118% increase in the stock price. And even the most bearish analyst thinks that there's still at least about 6% increase in the stock price in the next year. Now, despite that huge potential expected growth in the stock price, we have 10 analysts that say strong buy, 13 say buy, 10 say hold, 1 is actually saying sell, and nobody's saying strong sell. So Salesforce is a company that has just been absolutely beaten down. Analysts on Wall Street and Interflame Finance seem to think that there's a lot of room for growth in the stock price. First Solar coming in next at 6.85 for the average Interflame Finance score. Current stock price is $242. We think intrinsically it should be trading for $345 per share. That's a 30% margin of safety in the stock price of First Solar. Now, our intrinsic value of 345 is more bullish than the most bullish analysts, coming in at $330 per share. That would be a 36% increase in the stock price of First Solar. The average analysts think that there's only single-digit growth in the stock price of First Solar in the coming year. And there are some analysts with very bearish expectations for First Solar, saying that there's going to be a 38% drop in the stock price. Now, nobody's saying that First Solar is a strong sell. There is one sell among analysts. 3 are saying hold, 11 say buy, 10 say strong buy. So this average is just barely into the strong buy category of this little dial here. Let us know what you think about First Solar stock. Are you bearish or bullish on this? Do you agree with Interflame Finance thinking that it's going to be in the mid 300s? Do you think it's going to just sort of average out at about $250, $260 per share? Or do you think First Solar is actually going to plummet in stock price? Let us know in the comments below. And finally, the highest scoring stock is Intuit, coming in at 7.95, almost an 8, with one of the biggest margins of safety among all these companies. Current stock price, $381 per share. We think that the intrinsic stock price should be trading for $550 per share. Now, Wall Street does not agree with our $550 price target for Intuit because they are much more bullish than we are. The average analyst says that Intuit will come in at $773 per share in the next year. That would be a more than doubling of its stock price, between 103 and 106% growth in this next year. The high estimate coming in at $880 per share. That's a 131% increase in the stock price. And even the most bearish analyst says that Intuit should be trading in the next year at around $624. That would be a 64% increase in the stock price. And it's no surprise that Intuit comes in at a strong buy. 7 analysts are saying that this is a strong buy company. 10 are saying buy. 2 say hold. Nobody's saying sell or strong sell. It seems that Wall Street is in agreement with us that there's some room for growth. Wall Street seems to be even more bullish on this company, saying that there's going to be a doubling of the stock price in the next year. So how would we invest a hypothetical $1,000 into these companies? Well, they have to meet 2 criteria. Number 1, they have to have an average Interflame Finance score above 5. So Home Depot, Mercado Libre, and Monster do not fit the bill. They also have to have some margin of safety. Now we see that Mercado Libre, if you wanted to buy this company, if you think that our scores are too low, their current stock price is about $2,000 per share, intrinsically $3,800 per share. If you wanted to buy at a 15% discount on the expected price at $3,800 per share, you would buy Mercado Libre anything under $3,230, and you would buy very heavy anything under $2,470. Which means that if you agreed with our intrinsic value and you had to buy Mercado Libre right now, you would buy at these prices, and you would actually buy heavy because they are under the $2,470 mark. Now, this would be a good place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell any security, position, or company in your personal portfolio. Always do your own research. Always do your own due diligence before buying, selling, or holding any stock. Now, NVIDIA is not at a 15% discount, nor is it at a 35% discount, but there is a 12% margin of safety for NVIDIA stock. So we would nibble at this and we would buy about $97 of our $1,000 into NVIDIA. However, we would put much, much more into Salesforce, First Solar, and Intuit, given their very strong average score and given their very nice 30% plus margins of safety. We have $283 would go into Salesforce. First Solar would be $282, basically the same, and Intuit would get $338. And you can see the levels for buying at a 15% discount, and you would see the levels for buying heavy at a 35% discount. Salesforce actually fits the bill for both of those. It's currently trading exactly at 185, and that is our buy heavy mark at 185 as well. Now, what I've done here is I've changed the weights, 9 for growth and 1 for safety, which means if you wanted to really focus on growth, we would still not buy Home Depot, Mercado Libre, or Monster Energy, but we would buy these 4 companies, NVIDIA, Salesforce, First Solar, and Intuit, but we would devote a little bit different values to those companies. We see it doesn't change a whole bunch, but we do see a change in the amounts that we would buy of these companies. And finally, if we wanted to weigh more heavily on safety and less on growth at a 9-to-1 ratio, then we would invest nothing into NVIDIA now, but we would put a lot more into Salesforce, First Solar, and Intuit. So there you have it, folks. It's been an exhausting, crazy earnings season so far. We're not out of the woods yet. We have NVIDIA coming up. That's going to be the big dog, and I believe that's Wednesday. They're reporting their earnings. So let us know in the comments below. What are you buying? What are you holding? What are you selling? We appreciate you being here at Interflame Finance. Without you, we could not do this. Please, if you're getting anything out of these videos, like the video to help the YouTube algorithm spread the message to others. Please consider subscribing to the channel so you can keep coming back for more intrinsic value and stock scoring methodology that we have at Interflame Finance. Tell your friends, tell your family, tell your mother-in-law about Interflame Finance. We appreciate you being here, and we'll see you in the next video.